CitiGroup, one of the largest banks in the United States, has recently revealed plans to possibly lay off as many as 24,000 employees. This news has caused great concern among CitiGroup employees, who are now feeling a high level of unease and uncertainty due to the significant restructuring that the company is undergoing. The reorganization is expected to result in substantial job cuts across various departments within the bank. The number of potential layoffs amounts to about 10% of CitiGroup's total workforce, which currently stands at 240,000 employees. This initial round of cuts will have a significant impact on the workforce, leaving 24,000 employees at risk of losing their jobs. The banking industry as a whole has experienced a wave of layoffs, with Wells Fargo terminating almost 40,000 employees and Truist dismissing 3,000 employees. Moreover, over the past year, approximately 3,000 bank branches across the country have been shuttered, further highlighting the pain being faced by the banking sector. San Francisco-based bank, Wells Fargo, is also facing layoffs, with hundreds of employees being affected. Truist, another prominent bank, disclosed that they were laying off 3,000 workers. This announcement was in October's job cut tracker. Even Wall Street is not immune to these cutbacks, with reports indicating that around 20,000 financial jobs may be in jeopardy. Despite some CEOs predicting a soft landing, recent actions by these banks suggest otherwise. Jamie Dimon, CEO of JP Morgan Chase, for example, sold $141 million worth of his own stock in his company. This raises questions about the validity of the notion of a soft landing. The current economic environment is far from stable, with consumers facing challenges such as record-high inflation, stagnant wages, and soaring interest rates. This unfavorable climate has made it difficult for banks to thrive. The current state of affairs in the banking sector can be attributed to various factors. One important aspect to consider is the state of consumer finances, as indicated by the trending interest rates since 2004. These rates are booming, suggesting that people are being burdened by rising bills and expenses, causing them to prioritize their basic needs over fulfilling financial obligations. As a result, banks are tightening their lending criteria, making it increasingly difficult for businesses to secure loans. In 2023, businesses are in search of alternative sources of support due to the scarcity of available credit. Another concerning trend is the decline in the national and personal savings rates, which are plummeting. At present interest rates, this mortgage option might cost around $20,000 to $25,000, including closing costs and other associated fees. It's an exorbitant amount, but for those pushed to their financial limits, it becomes a way to secure homeownership. However, if the interest rates increase to 12%, the interest paid on a mortgage would decrease significantly from $31,000 to $2,000. While not ideal, $2,000 is a manageable amount for most individuals. But as the interest rate climbs to 33%, the situation becomes untenable. With a $31,000 mortgage, repaying it becomes an unrealistic goal for many. Some choose to default on their payments, which negatively impacts their credit report for 7 years. Unfortunately, credit card debt is a widespread issue, with some individuals carrying as much as $30,000 in debt. Even with monthly payments of $600, which is already a considerable sum, credit card companies expect a minimum payment of at least $825, if not more. Taking into account the interest rates, someone paying $830 per month would end up paying a staggering $126,000 in interest alone. It would take approximately 15 years and 9 months to fully repay this debt. It is no wonder that people are disillusioned with this system and are increasingly tempted to abandon their financial obligations.